Could mortgage rates go up even after the Fed cuts? Well, nobody wants to sit on that question for very long because everybody is banking on a Fed rate cut in September, and then they're banking on it directly lowering mortgage rates. Well, not only is that not accurate, but sometimes mortgage rates actually go up after a Fed cut. Yes, you heard that right. Today, I want to break down why that happens, how inflation is steering the bond market today, and what it means for your wallet. Stick with me. Because the difference between assuming a Fed rate cut equals cheaper housing and knowing the truth could save you or cost you thousands. Let's get started with inflation, the Fed's favorite problem child. Well, it didn't go as planned last week. Headline Consumer Price Index, or the CPI, was a steady 2.7%. Not terrible. But core CPI, which strips out food and energy, that rose 0.3% month over month, pushing the annual rate to 3.1%. That's the biggest surge since January. That's sticky. Yet, at first glance, the market didn't believe it, or maybe they just wanted to ignore it. Then 2 days later, the Producer Price Index, or the PPI, which is a measure of the costs companies pay for the materials they use to make a product, that jumped 0.9% in July, compared to a forecast of just 0.2%. That's almost 5 times hotter than expected. Typically, the markets don't move on the PPI report, but this time, it carried much more weight, especially after a hot core CPI. And why did it carry so much weight? Because wholesale costs ripple forward. In a soft economy where demand is down, businesses are going to try to hold back or absorb higher production costs, including tariffs, for as long as they possibly can to keep their demand up. But when demand picks up, as the Fed cuts the short-term cost of capital, those higher wholesale costs start getting passed on to consumers, which fuels more inflation, right when the Fed is trying to cool it. And here's the big disconnect. The Fed set short-term rates, but mortgage rates, they follow the 10-year Treasury yield, plus a risk premium, driven by the bond market, not by Jerome Powell's announcements. And a great reminder of this happened just last year, when the Fed cut the rate 3 times between the end of the year, for a total of a 1% drop in the Fed rate. Meanwhile, what did mortgage rates do? Yikes, they rose from 6.125 to 7.25. So cuts don't equal automatic relief. If inflation remains sticky, bond yields climb due to investors demanding higher returns to protect against the erosion of their dollars. And that pushes mortgage rates higher, regardless of what the Fed does with the short-term rates. Now, I also want to talk about wages, because opportunity and affordability isn't just about rates. With today's higher home prices and interest rates, many buyers believe they are priced out. And while home ownership might still not make dollars and cents, it is important to know your specific numbers versus guessing of it based on how the market feels. Case in point, wages are up 3.6% year over year, and personal income is also up. That includes not just wages, but self-employed business income, interest and dividends, and rental income. That's up a strong 4.74% year over year. And this doesn't even include capital gains from the current record-breaking equities and crypto markets. While this might be slower than the peaks that we saw in the past, it still is more than inflation in most markets, which means real wages, your buying power, is improving. Combine this with mostly flat home prices in many regions, and affordability isn't collapsing. For qualified buyers, wage growth is actually buying back some leverage, even if rates don't plunge. In fact, Moody's Analytics released a report showing home prices had been overvalued by 29.4% in the spring of 2022. Of course, this was after home prices heated up by a staggering 43.2% nationwide during the pandemic demand craze. Well, after 3 years of softer appreciation and softer home sales, Moody just reported that U.S. home prices are now overvalued by only 8.3%. Here in the Denver market, we had hit an overvaluation of 37% in the spring of 2022. But now we find ourselves with a third of that at 11.7% overvalued. That's the story that you're not hearing in the headlines. And as wages and personal income continue to increase, affordability continues to get more in line. So what's happening in housing itself? Sales forecasts keep getting revised down. The latest, from 4.24 million homes expected this year down to 4.14 million. That's sluggish. Inventory, meanwhile, remains elevated. Prices are flat nationally, with Case-Shiller's National Home Price Index up 2.3% year over year. Locally, Denver Metro saw a 2.26% decline in single-family detached home prices year over year in July, but it remains flat for the entire year-to-date 2025. What does that mean for buyers today? Less pressure, more time, more negotiating power, and more clarity. We're in a market where buyers can negotiate, not fight. That's a very different dynamic than the frenzy that we saw in 2021. The next 30 days will continue to give us clarity on where rates might land for 2025, with PCE later this month and another CPI and PPI 1-2 punch just before the Fed meets again. In fact, if you want to track them, here are the dates that are circled in red on my calendar. September 5th is a jobs report. September 10th and 11th is a PPI report, followed by the CPI report. And September 17th is a Fed meeting where Powell's comments and the number of dissents will tell the story. These shape inflation expectations, bond yields, and ultimately where mortgage rates head. Here's the bottom line. A Fed rate cut does not guarantee mortgage relief, especially given the sticky inflation we saw this past week. Resilient wages and income growth is supporting improved fundamentals, opening small but powerful windows of affordability. And a sluggish housing market in 2025 means more buyer control, less urgency, and more opportunity. If you're waiting for the perfect rate, you might end up missing the perfect opportunity. If you want clarity on your own buying or investing decision, drop your thoughts in the comments or hit the link below to run your numbers with my team. And don't forget to like and subscribe and share this video with someone you know who's sitting on the sidelines. I'm Nicole Ruth, and remember, real estate isn't about timing the Fed. It's about building wealth through clarity. See you next week.